Holistiplan presents Tax Time with Jeff Levine. Let's talk taxes. Jeff is the Chief Planning Officer at Buckingham Strategic Wealth. He's also at Holistiplan, our tax planning strategist. We work very closely, especially on projects like this one where there are changes or potential changes to the tax code. And we have to get all that coded in and figured out within our system. Jeff and I, we regularly record on Monday mornings. We try to do a video about every week. This one was big enough of a topic that we figured we would try to go live. And so here we are live. If you have questions, use the Q&A button. I don't think we'll be able to police the chat room too much for questions. So if you have Q&A, put those in the Q&A button on Zoom. And we put 30 minutes in the calendar for this. I would be highly surprised if we got done in 30 minutes, but we'll see. But if you have to run, I totally get that. We will have a recording out there. It'll be available from info@holistiplan.com or from Zoom. We also have a YouTube channel, and so we'll put it up there as well. And so, yes, the goal today, Jeff, like you were saying, is to talk about the now 4-day-old tax proposal, which our thought was, rather than talk about that versus just current tax rules, let's look at that versus the previous proposal versus potentially the campaign promises made about tax proposals, and then also current law, because that provides the full context that we have to provide to clients about where this fits within the larger story, what changed, what's different now versus a few weeks ago. So Jeff, I will turn it over to you. What's new, or rather maybe what's not new with the new proposal?
Yeah, so I think that's, interestingly enough, I think that's where we need to start here. So often when we're talking about new legislation or proposed legislation, what we do is we start with like the headline changes, what's going to be changing. But here, I think the headline really is how little appears to be changing for the average client. And that doesn't mean, by the way, that we should just sit on our laurels and not look at how those who will be affected should be affected, or even communicate out to those who aren't affected that they won't be. I really want to emphasize that, right? There's been so much concern surrounding these tax increases. The story I like to share when I'm talking to folks about this is one of my own clients who we were working with, and called me up early this year, and was so concerned, like, oh my goodness, how is this going to impact my retirement? What is this? And this was someone who had a very comfortable retirement income, about $150,000 or so a year of retirement income, which is, by any measure, when you look across the country, a great retirement income. It's an income that many people would like while they're working each year. And yet this person was so concerned about the potential for their retirement to be derailed by tax increases. So ultimately, just sharing that, hey, it looks like at that point saying, hey, we're only going to see this for those about over $400,000, that was able to really de-escalate that client's concerns and gave them a sense of peace that we serve as advisors. That's what we're doing, right? We're trying to give clients that peace of mind, not to do it when it's not actually right? We don't want to lie and be like, yeah, you're good, when nothing is right. But when things are good, like, we want to deliver that peace of mind to clients. And so with that, I would say the headline news is the ordinary income tax bracket. It looks like that top rate is not going to be 39.6%, but going to stay at 37%. And the top long-term capital gains bracket looks like that's going to stay at 20. It looks like the top rates are not changing. Now, having said that, and I know we'll talk about planning in just a bit, so I don't want to get ahead of my skis here, but it is worth noting that on the ordinary income tax side and the estate tax exemption, which also doesn't look like it's changing, it looks like they're going to keep it where it is today. It appears that by leaving that as is, we're still going to be in a phase out of, or sunsetting of, those provisions, right? At the end of 2025 into 2026, we're going to see those go back to their pre-TCJA levels unless nothing else changes. And it's really hard to imagine that that any sort of bipartisan Congress or any, if either the presidency or the House or the Senate is maintained, controlled by Democrats. It's hard to imagine those getting extended out further. And so we still have a relatively limited window of time in which to do some planning. And so what I've tried to talk to folks about over the last few days, just the last 3 or 4 days or so, is that really everything that we were looking at doing just a week ago or 4 days ago doesn't mean the planning is gone for that. We just kind of delayed the urgency of that for another few years. So we've probably got another 3 or 4 years of low income tax, high estate tax exemption time in which we can take advantage of for clients, whether that be through gifting or Roth conversions or accelerating gains, et cetera. I think we're still in this temporarily low tax environment. Now, beyond that, there are other key changes to the law that, or key changes to the proposal that we're looking at. And again, who are the winners here from a tax perspective in terms of who's got higher taxes, who's got lower? This is a scenario where if you look at the Biden plan, the House plan differed dramatically from the Biden plan. Like, even if we take long-term capital gains, right? Roger said, like, let's take a look at the 3 different versions here. Well, President Biden initially said, let's create a $1 million cap or threshold, if you will, where after that, everything is going to be taxed at the same rate, the 39.6% proposed by Biden. That would have been a huge impact for those with more than $1 million of income per year, which includes a lot of our clients when they go to sell appreciated property, or if they have a business that they want to sell. Many of you, right, when you go to sell your own practices, could very well see north of $1 million of income for the year. Not every year necessarily, but a temporary spike. If all of a sudden you go from 20% to 39.6%, that would have been huge. Well, the House version sort of minimized that concern for the ultra wealthy, the ultra high income. But what it did was it made the higher tax rate, the proposed 25% tax rate, applicable to a lot more people, right? It was going to align the top ordinary rate and the top long-term capital gains rate. Here, with the proposals going forward, there is no direct change to the long-term capital gains rate. Now, I say direct change because there are really 3 tax proposals that I think are the biggest ones that we need to keep in mind going forward for clients. 3 key changes that look like are actually going to happen here. So the first of those, and then Roger, I know we've got a lot of questions coming in here. We can turn to questions or talk a little bit about planning, but the first of those key changes are surtaxes kicking in for individuals. And there are 2 levels, if you will, of surtax under this proposal. There is a $10 million threshold for most, for single filers, joint filers, heads of household, et cetera. It's half of that for married filing separate, but everybody else gets a $10 million threshold. And there it's a 5% surtax on income above that mark. So if someone has $11 million of income, then $1 million would be subject to this 5% surtax. And what's really critical to understand is that when it comes to that surtax, it's not just ordinary income. It's looking at AGI. And income is income is income is income for AGI purposes. In other words, it doesn't distinguish whether it's interest income, earnings, a capital gain, et cetera. It doesn't care. It just wants to know how much income you got, right? What total it all up, and if you're above this mark. So that effectively takes both the ordinary rate and the long-term capital gains rate and bumps it up by another 5%. Then there is a second level of surtax for those with more than $25 million of income per year. Again, a fairly stratospheric income level for folks today, right? Like that, I would suspect that almost none of our clients have that on an ongoing basis. And yet many of you probably have a client that if they sold their business, you've got that one client who's got a business that's just rocking it. If they sold that business outright, perhaps they could eclipse that mark too. That would be another 3% on top of the 5. So if you think about it from a federal income tax perspective, for things like interest, et cetera, the top capital gains rate now becomes 37% plus 5% plus 3% plus the 3.8% surtax is 48%. 0.8%, pretty high, right? We're getting pretty close to 50% at the federal level. But the thing is, that only applies to stratospherically high income. Where I think advisors will run into this are two places most. And Roger and I were talking about this a little bit over the weekend. One is, the sale of an appreciated asset, including a business, right? Those one-time, once in a lifetime events, or few in a lifetime events. That would be the first one. The second place where we are likely to see this, though, is with trusts as beneficiaries. Now, the good news for a lot of our clients is that in this version of the proposals, the thresholds for that surtax have been bumped from what a House version earlier called for. House version called for a $100,000 per trust threshold. This calls for $200,000 for the 5% mark and $500,000 for the additional 3%. And you say, boy, that's still a lot of income. I mean, if you think about interest and dividends and capital gains, it takes, especially if you do a good job with tax loss harvesting, it takes a lot of wealth to get to $200,000 of income, right? Think about where interest rates are today and dividends, et cetera. But for sure, I see somebody here saying, what's the trust threshold? Again, 200,000 for the 5% threshold to kick in. This is for trust and estates, and 500,000. So whereas individuals get the two thresholds kicked in at 10 and 25 million, the trust would get there at 200,000 and 500,000. And where, again, while I think it takes a huge amount of income, or assets rather, in a trust for most trusts to earn that from interest, dividends, and capital gains, let us not forget that roughly 2 years ago now, coming up on the 2-year anniversary of the Secure Act, the post-death distribution rules for retirement accounts dramatically changed, right? They went from being a lifetime distribution, a stretch, if you will, for beneficiaries as the default, to being a 10-year rule for most non-spouse beneficiaries, including most trusts that are benefiting non-spouse beneficiaries. So if you think about it, right, it doesn't take a particularly large IRA. I'm not like, relative to the average person's IRA or retirement account, yes, but for the accounts that advisors deal with, a $1.5 million IRA left to a trust could quite easily produce distributions of more than $200,000 per year, right? If you apply like a 7% growth factor to traditional IRA trusts, to a $1.5 million account, and you amortize it over 10 years, effectively say, what is the level amount that I could take out to spend down this account over 10 years? Well, in that particular instance, then you're talking about more than $200,000, about $215,000 of income per year. So already that in and of itself, if it goes to a trust, could trigger some of that surtax on top. So we've got to keep that in mind. That's the first one. The second one, and I've seen a couple people already talk about, ask questions about the net investment income. Let's go there, because that is a key planning issue for individuals, right? I think that is going to be the change in the tax law that is likely to catch more of our clients than any of them to increase their tax rate, right? Still not a large group, right? Because it's going to take someone with high income and an S corporation generally. But how is that going to impact folks? In short, once an individual would have more than $400,000 of income, actually, Roger, check me on this one. I think we're at 400 and 500,000 on that threshold, right? This is for the S corporation included.
That's my recollection too. Yep.
Yeah. All right, so good. Just want to make sure you were still with us, Roger.
Yeah, I'm awake. Thank you.
All right, good. The $400,000 and $500,000 thresholds for single and joint filers, respectively, we would go from having none of an individual's S corporation subject to the 3.8% surtax to, over the next $100,000, having all of it subject to the surtax. Now that has really interesting ramifications for our clients from a spike in marginal rate, which is ultimately what we should care about as advisors. Too often we focus on the bracket. The bracket is not what ultimately matters. The bracket helps inform what the rate is, and the rate is the thing that ultimately matters, right? So if you're throwing in a whole bunch of more income into a particular bracket, well, then you're getting a higher spike. This is comparable to what a lot of you have dealt with before in terms of the Social Security tax torpedo, right? The higher spike in marginal rates someone might have from seeing their QBI deduction phased out, right? And that's a great example. For every $1 of income you're actually bringing into a return, you're adding $1 of income, but you're also then subtracting a little bit of QBI deduction. So you effectively pay tax on more than $1 for each $1 of new income. Well, this would be a very similar philosophy to that, but would be looking at the 3.8% surtax. Effectively, again, from 400 to 500 or 500 to 600,000, depending upon filing status, you go from having no S corporation profits subject to the surtax to having them all subject to the surtax. So let me give you an example of where you would see this create a really funky marginal rate for clients. Suppose you have a single individual who has $100,000 of salary from their S corporation. Okay, that's the salary they pay themselves. If you are an owner of an S corp and you do work in the business, you have to pay yourself a reasonable salary. Let's suppose that's it. But let's also suppose that it's a pretty successful business and they've got a whole bunch of other people working for them, and maybe they don't spend as much time doing the work as they used to. And so they're able to reasonably justify taking a fair amount of the income as profits. And in our example here, let's say it's $300,000 of profits. So our single individual has $100,000 of earnings, W-2 income they paid themselves from their own business. And then after all was said and done, at the end of the day, they had $300,000 of profit. Well, we look at the threshold. We see it's 400,000. They have 100 plus 300 is 400,000. They're not over it. Therefore, none of their S corporation profits are subject to the surtax. But now, let's suppose that the business actually has a better than expected year. Turns out when the business owner goes to file their tax return, they're pleasantly surprised, at least at first, that they had another $100,000 of net profit. So really, they have 100 plus 400. All we did, right, was add $100,000 of income to that individual's return in the form of the S corporation profits. But now, because they went from 400 to 500 and they are all the way through that threshold, now the S corporation, not the extra 100,000, but we're going to treat all of their S corporation profits as net investment income. So all 400,000, right? We go from having none of it included at 300,000 to having 400 of it included at $500,000 of total income. That would create a very weird spike in marginal rate for that client, right? And ultimately, the true end net result for that individual, how much extra tax they pay, would depend upon how much other income they have in terms of interest and dividends and capital gains, because those two would be subject to the surtax. But that could, depending upon the client's situation, result in having $0 of S corporation profit subject to the surtax, to, by adding 100,000 more of profit, having 400,000 of it subject to the surtax. That's 3.8% times 4, or 15.2% marginal spike just on the surtax. Forget about ordinary income tax, but just on the surtax by going up that $100,000 of profits. So from a planning perspective, right, if we were an advisor advising that client, what are we looking at? We're looking at doing whatever we can to knock them back below that threshold. Question is this before or after QBI deductions? And I'm going to look at the questions that we have here in a bit. I just saw that one pop up, and since it's right on point, let's address it. This is before the QBI deduction. This is actually going to be on AGI, right? So, and QBI is actually after, right? So QBI, I effectively call it a below the line deduction, because your QBI deduction is set based on what you take after your above the line deductions, what you have as your standard or itemized deductions, and then you look at your QBI deduction, right? This would be well before that in our kind of order of operations in terms of figuring out income. So the question here, to Dana's point, so the additional NIT is 4 times 3.8% on just 100,000, so $15,200. The answer to that is Yes and no. If you want to be technical about it, it's not $15,200 on that 100,000. It's across the 400,000 of S corporation profits that the individual had in our example. But you only have it subject to that because you added the $100,000. So you really, from a marginal rate perspective, and this is where I go back to saying, forget about the bracket, care about the rate, right? This is where using like a holistic plan, like looking at the chart, right, and seeing what happens if I add another $100,000 of income or whatever. That chart becomes so valuable because you can envision that. What happens here if we're adding just a little bit more income? You want to look for those large spikes, and more than even just the spikes, the large plateaus of elevated marginal rate, right? Because if we go to a large spike, a Medicare Part B premium, for instance, right? That's a huge vertical followed by a huge downslope, if you will, right? It's very narrow. In fact, it's $1, right? $1 takes you to a big spike in marginal rate because you have all that additional Medicare premium for $1. But then that's it. Whereas a large plateau, and then you get to a lower rate, that can impact income over a longer period. So that is absolutely critical to keep in mind here for our S corporation clients. Now, again, how this would ultimately impact their taxes depends upon their other income, because we still only hit income above 250,000 for married couples filing a joint return with this surtax, and for individuals with income over 200,000. So if I go back to my example one more time, because I see a bunch of questions coming in on this, and then I want to move past and give you the last one here. So if we're looking at how this would work, the $100,000, let's make this a true example for our client, where they have $100,000 of salary that they've paid themselves, $300,000 of profit, no other income, to keep our example super simple. Well, we know they have no surtax at all because they don't have any net investment income in this particular instance. They are below the 400,000. And so we don't consider any of their profits investment income, and the salary is not investment income either. So they would not have this surtax. But again, let's pretend now they added another $100,000 of profit. They move through that phase out. They go from having none of that profit, previously 300, now 400, subject to the surtax, to having all 400 being deemed investment income. So they now have $400,000 of investment income in our example, and another $100,000 of salary that they've still paid themselves. So $500,000 of total income. If we compare that to the 3.8% surtax threshold of 200,000 for an individual, they're 300,000 over. So in this example, if they had no other income whatsoever, it actually would take zero. It would take it from $0 to $300,000 of income being subject to surtax. But let's say they had another $100,000 of income from somewhere else. Maybe they have, maybe they have a second job. Maybe they have a spouse who's got a lot of income, et cetera. That might change their threshold. But the point being is that they could see all of their S corporation profits, but not necessarily, because you still have to look at the original threshold amounts on the surtax, right? So I'll give you an example to make that point pretty clear. Imagine you had someone with $50,000 of profit from their business and paid themselves $50,000 of salary, right? There, if they add a little bit more income, let's say they go to $100,000 of profit, they're still below the threshold, so it doesn't impact them. So we've got to look at this. Again, this is where running through things through like a holistic plan or some other tax software, but would be particularly valuable, right? That would be particularly valuable for you. Run it through holistic plan. Roger's already got this stuff coded in, which just like sometimes people will send messages and say like, how'd you go through that already? I say like, I got the easy job. All I got to do is figure out what it says. Roger has to figure out how to make the software actually spit that out to you guys. So he's got that done already. You can already run these projections for clients in there. You got to know how to use the system, input the inputs the right way. But not to handle S corporation returns. So great question, Stephanie. Not to handle S corporation returns, but we're looking here at the individual. None of what we're talking about here is on the S corporation return. This is all on the individual's income tax return. That would be where the inputs would be determined by what already happened on the S corporation return. Right. So the profits of the business, the salary that was paid from the business, et cetera, all of that would be there. So perfect. So let me turn it over to Roger, see what Roger would like to add here. And if not, if nothing to add in terms of software and stuff like that, we can move on and take some questions, because I do see a lot of them. And I know we're at 10:30 already. So Roger.
Yeah, so I would say, Jeff, how about we plan to do a separate call? We can do it next week or the week after, where we can maybe show some visuals on that net investment income tax thing, which I think is kind of mind blowing if you really kind of see it. I know you went through several examples, but if it's not sinking in for folks, we can promise to maybe show some of that in the software, running numbers and showing that impact on the range calc screen. So that's one. I think just another thing I'd highlight is, there was a question about does the QBI deduction or even below the line deductions impact some of these things? And it doesn't impact the net investment income tax thing for S corps. It also does not impact those surtaxes. So it really seems like we're, as a planning tool, we're kind of losing. If the winds are blowing in this direction, we may be losing below the line deductions, specifically some charity planning, as one of the levers we can turn, one of the dials we can turn to as a planning tool, because it seems like the new stuff is all based on AGI. So that's just two things to highlight there, which, by the way, yes, is coded into the system. If you want to run numbers on these things side by side, that is all there. If you want to run current law versus proposed. So maybe we turn our attention to planning implications. It's now November 1st. Like, it's November 1st. It's terrifying that we only have 2 months left in the year, but there are potentially some decisions we can make as planners. One is just demystifying for clients what is new, but there may be actual planning decisions we can guide a client through. So maybe we try to cover those. And I identified some at both ends of the spectrum. Obviously, there's some for very high income folks, but at the other end of the spectrum, what you did not mention was the refundable child tax credit extended to 2022. So 21 and 22 is still there, which means it will be in these 2 years imperative for our clients who are down in the less than 150,000 AGI range to try to keep them low. So maybe switch those Roth 401k contributions to pre-tax potentially. Mm-hmm. Also, one that is going away that exists in 2021, but going away, as far as I know, in 2022, is the incredibly lucrative dependent care credit.
Yeah.
The refundable dependent care credit, which is if you run the numbers on it, it can be massive. And no one's really seen it, because unlike the child tax credit, they're not paying that out monthly. It's something that people will only see in April. And then by then it's too late to realize that, hey, I really liked that little benefit. It'll be gone. So from a planning perspective, I would say, to the extent possible, push income or pull deductions into this year to the extent you can. If you have clients down in the less than $150,000 or near $150,000 AGI range, try to generate as many above the line deductions as you can. And we don't have a ton of control over what we can do there, because again, this is above the line rather than below the line, where we can bring charity into play. But potentially that SEP IRA contribution that the client has been hesitant to do in years past, or the self-directed or the self-employed 401k plan, which maybe they thought wasn't worth the trouble in past years, could very much be worth the trouble now. And that's at one end of the spectrum. Of course, at the other end of the spectrum, if that AGI is near $500,000, maybe bring income into 2021 for someone with an S corp, so you can maybe kind of lower that net investment income tax impact next year in 2022. Although, it's here to stay. So it's really just 1 year you can deal with it. And then I guess the same would go for clients with AGIs over 10 million. If you can bring income into 2021 versus 2022, that at least pulls some money away from that surtax that we'll start seeing in 2022. Yeah. What did I miss,
Jeff?
Jeff?
Perspective, Roger, you brought up the child independent care credit. I just want to put a pin on that point for a second. that Roger said it was, it's pretty substantial where it exists. Let us keep in mind, right, that the normal child independent care max credits are $1,050 for one qualifying child and $2,100 if you have more than one qualifying child, so two or more. This year, that is quadrupled almost to $4,000 and $8,000 effectively. So for a married couple with two or more children, right, you're looking at the difference between a $2,000 credit and a $8,000 credit on top of the increased child tax credits. If you've got families that have kind of held their own throughout this pandemic and they're kind of just ticking along like usual, that could be a $6,000 swing on their tax return come April. What I would do now is get out ahead of this, because if it goes into the client's bank account, it's gone, right? Once it's in there, it's like, what refund? What are you talking about? And whereas if you do it now and say, hey, that's a whole year's IRA contribution that we can use. Like, let's think about that proactively, getting out to clients and saying, let's use these dollars that you're expecting back. I do see some of you have put questions into the chat box as opposed to the Q&A box. I know, for time purposes, we'll shift to questions, but I'm going to ask that if you put a question into the chat box and you want us to address it, try and put it into the Q&A box. It's really hard to follow and mark off things in the chat box. So if you put something in there, you have a question that you wanted. So I see someone here, for instance, the last one is, does that include elderly dependent parents? I'm not actually even sure what that's referencing. Maybe the child tax credit, not sure. But that's, put that into the chat box as well. So I mentioned earlier that there were three things, into the Q&A box, not the chat box. I mentioned earlier there were three things. The third one is the qualified small business stock, but there are a couple of questions here in our Q&A that address that. So I'm going to pop there and we're going to do rapid fire to try and answer as many of your questions as possible. And there are some really good ones here in the Q&A. So first one, what are the chances that they disallow private placements in IRAs? So for those who don't know, the House version of this bill said any investment that requires a minimum education knowledge, a minimum experience knowledge, a minimum asset level, a minimum income level cannot be purchased with IRA dollars. Period. End of story. Right. So if any, that would be obviously private placements, because you need to be an accredited investor, and there are accredited investor rules in terms of income and assets. But many of you use non-traded REITs, or some of you might use interval funds that require certain income or liquidity type of things. That would have been disallowed under the House version of the bill. That's gone. As is, by the way, and I think probably the headline, for a lot of advisors from this was no death of the backdoor Roth, right? That appears to have lived on beyond this, that appears to be living on. Now, I say appears because it's not in the final version, the quote unquote final version of the bill, but that's not going to be the final version of the bill. It's not going to be the final version of the bill. That version of the bill is what they've effectively agreed to on the revenue side and the expenditure side. So you're not going to see big changes from here in all likelihood, right? I guess never count your chickens before they hatch, but it's highly unlikely you're going to see something that's like, oh, surprise, we actually are raising the top rate, or surprise, you're going to have a higher capital. Those things materially impact the inflows and the outflows. Where you could still see some significant changes for our purposes as advisors, as planners, is on the rules-based side of things, right? And things that can be done to be revenue neutral. So one of them might be like getting rid of Roth conversions in 10 years. Doesn't impact the budget effects of this bill. Could see a scenario where they stop backdoor Roth conversions. It's not in this version of the bill. It appears that was taken out as part of the negotiation process. So it's not likely to come back in, but it's more likely than the things that would impact the revenues of the bill, the budgetary effects. So for that reason, again, that question, good thought, but doesn't appear to be in the final version of the bill. Can you talk about the effect of the qualified small business stock? Does the sale of the qualified small business stock count towards the 400 AGI limit? Excellent question. Let's start from kind of a high level. First off, what is this QSBS? that people are talking about, right? Some people are asking a question right now, which is, what is this QSBS you're talking about, Roger? I think that's going to be my new standard line for this. So what is this stuff? Effectively, if you have qualified small business stock, so a new company that is a C corporation that's issuing like founder shares, if you will, you are able to exclude a portion of that gain, or sometimes all of it, depending upon your situation. Right now, there's up to 100%, a 100% exclusion. That would be cut back to up to 50% exclusion. So let's say you invested 100,000 and your shares grew to be worth, $5 million. Instead of being able to exclude the 4.9 million of growth, if this provision impacted you, it would be 4.9 divided by 2, or $2.45 million that you could exclude completely from your income. Pretty good deal still, but not the same as 100%. The question here was specifically, what about the sale? Like, hey, if I sell something for $5 million, and again, founder stock, stuff like this often has a pretty big earnings. And if you hit it big, that's when you get to sell it. You're going to have a lot of gain. Yes, it does appear that the gain from the sale would count towards that 400,000 AGI threshold. Notably, when we're looking at this, it says the language of the bill text, which I don't have in front of me right now, but it says something to the effect of calculate AGI without regard to this section. Well, if you calculate AGI without regard to the section that excludes the income, you got to include it. And that in and of itself, the gain will push a lot of folks north of $400,000. So really for purposes of that break, it would take it. And this is the one provision, this is the other notable thing about this one. This is the one thing that of all the changes we talked about, the surtaxes and the S corporation and the NIIT, et cetera, all that would be effective as of January 1st. This change would be effective still as of that September 13th date. So after September 13th, unless there was a binding contract. So it's not like if you've got clients with founder stock now, they can just kind of run out and sell this real quick and try to get in under the gun before the end of the year. It appears that that would already be too late. What are the next steps for the legislation? Why is the process from House text released on Thursday to signature by President Biden? There are still some things for them to work out. So this is, as I mentioned, not the final version of the bill. It's just the final. And the reason why, again, is there are some things that still have to be addressed. Chief among them is going to be the SALT limitation. Okay, so from a planning perspective, this is one that you definitely want to pay attention to, because there are some true impacts here for your clients. There are one of two possibilities that Democrats are looking at. And while I can't guarantee anything, I would be utterly shocked if SALT is not included, some sort of SALT relief is not included in this final version of the bill. When it actually goes to a vote, if SALT is not included. There are too many coastal Democrats in particular who have run on a platform of, we will get rid of that thing. Right, that was a large part of what they ran on. And with midterms coming up, they're not going to be able to go back to their constituents and say, yeah, we passed a big comprehensive tax bill, or at least some sort of big bill, and we didn't end up repealing or helping you out with SALT at all. So I think that's highly unlikely. Instead, what they're, I think, trying to work out now is whether they want to do one of two revenue neutral things. One is to, instead of just repealing the cap altogether, put in a very high cap, but one that would be permanent, like a $50,000 cap on SALT deductions for individuals, maybe even higher than that, but where it would apply forever, right? So now that becomes a permanent feature of the law, whereas the SALT deduction is set to, the SALT cap rather, is set to expire with the Tax Cut and Jobs Act expirations at the end of 2025. They could just cap it, but at a very high level. The other possibility here is that they do a complete repeal for the next few years, but they bring back the SALT cap in 26 and 27, or some later years, but within the 10-year budget window. And all this is, and anytime you talk about tax policy, you run the risk of getting into political discussion here, but I'm going to try to give this to you as objectively as I can. This is not an I like it or I don't like it. It's a budgetary gimmick. And both parties do this sort of stuff. And I know somebody's going to say, don't both sides this. This is truly one of those where it is really both sides. Whenever we get into these bills, both parties play games with the law in order to make things work from a budgetary perspective. High level here, look, over a 10-year window is what Congress people care about. They don't care what happens before or after because it doesn't show up on that budgetary impact. That's why whenever you hear someone say the impact of this bill is, there's always some like deep, dark voice, like over the next 10 years. It's always a 10-year period. It's not because they like 10 years, it's because that's what the federal budget looks at. So remember how we've all dealt with things like the extenders, the tax extenders, where we're kind of like, why don't they just make these darn things permanent? Well, the reason they don't make them permanent is if they make them permanent, then you've got to show their effect each year on the budget. But if you only make them temporary for a year or two, and then they go away, but then you bring them back for another year or two, well, it's only hitting your budget sheet, your profit and loss, if you will, your expected profit and loss, if you will, from the government side for that year or two, because they can't project that something will be in there if it's not stated to be in there, even though we know it will be there. So what Democrats are hoping with that possible 2-year repeal is that we go from a situation where it's fully repealed this year, they bring it back in the future, but that they're able to sometime between now and then change that law in the future to eliminate it then, right? It's just kind of pushing that 2-year period down the road with the hopes of further pushing it down the road. And again, this is something both parties do, right? The whole reason we have a sunset on the individual tax part of the Tax Cut and Jobs Act, and that is not a permanent thing in the tax code today, is because Republicans did the same thing. They wanted to pass corporate tax cuts and individual tax cuts, but they can only, in the 10-year budget window, let the individual taxes go along until 2025. Otherwise, it would have put their deficit too high. They didn't want to increase the deficit by more than $1.5 trillion at the time. So this is what budgetary math looks like. And that's where that's what we're going to have to do. We're going to first have to resolve what the final version of the bill is. Then the House and Senate will vote. They will likely vote on the same bill. So normally, if there's a House version and a Senate version, they have to get together in conference committee and work things out. Here, it appears that all that negotiation is being done behind the scenes already. So in all likelihood, it'll just be one bill with no changes going through both houses that will then go to the president. Still have a little bit to go yet. But from a SALT perspective, I do want to kind of tie the bow on that. If you've got clients who have the ability to make state income tax payments, federal state income tax payments for Q4, from a federal tax perspective, it makes sense to do those in January of next year. Same thing if you've got clients who have property taxes here as we get towards the end of the year, and they can shift them into 2022. It likely pays to do that because we know what the SALT cap is going to be this year. There was initially some hope on the part of some that they would repeal or at least alleviate the cap this year. That no longer appears tenable. But it does appear that in 2022, they're still working hard to increase that cap or to eliminate it altogether. So if you have the ability to make state payments next year, do that. All right, you said the top rates are not going to change, but are the brackets going to change? No, so there's the brackets would stay the same based on the current version of the bill. So the top ordinary rate would still kick in at about 650,000. And by the way, we're in for a really decent cost of living adjustment next year. So clients are going to have, if their income stayed level, they're going to see a lower tax bill going through next year because of inflation. Those brackets are going to see bigger changes than we have seen in quite some time. So that in and of itself could be a little bit of a tax cut for clients as well. Regarding estate planning, will the grantor trust stay? It appears that all the grantor trust issues have been removed from this bill as well. I don't expect to see those come back. Those are pretty, those would generate revenue and move the dial on revenue. It appears that perhaps that may have been some of the things that were negotiated to say like, okay, we're going to get rid of this, but we're really going to hammer them with these surtaxes, the ultra wealthy. So it appears that grantor trusts, so things like ILITs and IJITs and SLATs, and let's see what else would be on that list. Just simple, everyday, grantor trusts. Those are going to continue to work. Like RATs, all of those would seem to continue to work. And again, would be really interesting strategies to look at considering over the next few years, given that we might be going to a lower state tax, not today, but perhaps the exemption could be cut in just a few years from now going into 2026. Do you believe defective grantor trust would be eliminated? Again, kind of echoing on with what we were just talking about, seems like that's not the case. Will the 5% and 3% surtax begin on January 1st or effective from the enactment of the bill? Those would be effective as of 1/1/22. So if you have clients that are in a position where they would be impacted and they could accelerate some income into 2021, that would be advisable. Does the trust income include capital gains? Yes, this is on AGI for trusts. So if you had an IRA that was kicking out money to trusts and then it was staying in there, maybe this was a trust created for young children and the trust said, hey, hold this money in there until they reach like 35. Well, if you had $200,000 of IRA distributions going in there and only 200, the first year there would be no surtax owed because the trust income limit is 200,000, right? But the next year, you now have that 200,000 in the trust earning interest and dividends and capital gains, et cetera. Plus you have your other 200,000 coming in from your IRA. So now some of that would be subject to the surtax. The year after that, even more would be subject. The year after that, even more would be subject, et cetera. So yeah, got to keep an eye on that on the trust side. Again, I think that's one of the areas where advisors could be hit. Are the surtaxes permanent? Yes, everything we're talking about here in the bill would be permanent, permanent in Washington speak, right? Nothing when it comes to tax policy is truly permanent. Permanent just means it's here until a future Congress decides to override what we're doing. But yes, these would be quote unquote permanent. For trusts that distribute income that doesn't avoid the issue of the trust, yes, that would avoid the issue, yes. So in my example there, I was saying, what if it's for young children and the trust holds it? If the trust passes on that income, then absolutely. Then if it passes on in the same year, then the trust gets what's called a DNI, distributable net income, DNI deduction, and the income is picked up on the individual's income tax return. That is the individual beneficiary's income tax return. The problem with that, though, is that if you're passing out all that income, and again, with the 10-year rule applying to a lot of non-spouses, it's not the small amount that it used to be, right? The annual lifetime distribution, it's a significant amount of income in a lot of places, especially, right? If you name a trust as the beneficiary, it's probably not a small account. It's probably a big account because otherwise, why name a trust? Why go through the trouble? So if you're passing out 1/10 of that each year, are you comfortable with the beneficiary getting that? And if you are, did you really need the trust in the first place, right? These are the types of questions we're working through with advisors. Regarding trust, so a lot of questions here. I'm assuming IRR trust, irrevocable, I'm thinking, won't this pass through to the beneficiary on that return? It depends. So some trusts, there are two types of IRA trusts, right? We could spend probably 5 hours on this, but at a high level, you have trusts as beneficiaries. If a trust meets 4 rules, it's valid under state law, it's irrevocable at death, the beneficiaries are identifiable, and a copy of the trust goes to the trust by October 31st, the year after death, then that trust can qualify as a see-through trust, meaning it can be treated as a designated beneficiary. Now, after the Secure Act, it might mean the 10-year rule or it might mean the stretch. That depends upon looking further, but at least it can get one of those two. It's a designated beneficiary. From there, a trust that is a designated beneficiary, a see-through trust, can be either a conduit trust or a discretionary trust. In a conduit trust, whatever comes into the trust has to go right out. No choice on the part of the trustee. In that case, the income tax liability ends up following the money out to the beneficiary, right? Out to the trust beneficiary. In a discretionary trust, A trustee may have the ability to do that, but many times they either don't have the ability. The trust says hold dollars in here for X amount of time, or the trustee just thinks this is the better solution, right? This person can't get the money. That's why I have a trust in the first place. I'm going to hold these dollars in here. If they're held in the trust, they're going to be taxed at trust tax rates. Is the 400 or 500,000 AGI or taxable? I'm going to assume this goes back to asking questions about the S corporation. Those are AGI based numbers. Does bonusing out the S corp earnings as payroll help? No. Great question. The answer is no. And in fact, if you're the S corp owner, is probably worse, because here's the deal. At a high level, you say, why are they doing this? Why are they inputting the S corporation, or why are they trying to make S corporation profits subject to the 3.8% surtax? If you're an S corporation owner, you're obviously not happy about it. But if you're being objective about this, there is a rational basis. Again, whether you like it or not, that's a different story. But there's at least a rational basis for doing this. And that rational basis is, look, everything else nearly is subject to either the employment taxes like FICA, so Social Security and Medicare taxes, or is subject to the 3.8% surtax. Other than S corporations and retirement account distributions, name me something else that doesn't get hit by either. Really tough to do, right? Really tough to do. There's very few things that fall into that category. And so this is meant to kind of level set. And you say, well, that's 3.8%. People don't pay that. Well, if you're a self-employed individual, you've got both ends of the Medicare tax if you're above the Social Security threshold still, right? So certainly, and the question here was, will bonusing help? No, because while if you are a sole proprietor or partner, once you get above your Social Security wage base, then you're only responsible for the Medicare side. If you're paying this as payroll, right, and maybe you have another job also, you might end up playing the employer part unnecessarily. So not only the Medicare part, but also the Social Security part. So if anything, it would actually damage the situation, not help it. Can you touch on types of IRA investments IRAs are allowed to do? Can IRAs still invest in private placements and investments where you need to be accredited? As of today, the answer is yes. You can certainly do that. It appears that the restrictions on the bill have been removed. So as to what can IRAs invest in, as far as what the tax code says, it's everything in the entire world that you could possibly invest in, except collectibles, life insurance, and S corporation stock. And that last one isn't even an IRA rule, it's an S corporation rule. So that's for that. Just for clarification, is it the income from the pass-through or AGI? So that's pass-through is 475 and Magi is 700,000. I think this is going back to the S corporation again. If your AGI, so if we take all your income and all of your income is above your phase out, then your S corporation profits are considered net investment income. So if you imagine someone, here's a good example. Married couple, one spouse makes $600,000 of W-2 wages. So that spouse's income already pushes them over the threshold. The other spouse has $25,000 of wages and $300,000 of S corporation profit. All $300,000 of S corporation profit is considered net investment income. Let's go the other way. Let's say it's the other spouse has $50,000 of S corporate. It doesn't matter. Every dollar of those S corporation profits would be there because their AGI is over the threshold. If AGI is over, then the S corporation profits are considered to be investment income. Is this to be effective 1/1/22 or 21? Again, I think that looks like it came in earlier on. Everything we've talked about so far would be 1/1/22 with the exception of the QSBS, the qualified small business stock. Did you discuss Roth conversion backdoor already, or is that too basic for this discussion? Again, high level, it appears that that's sticking around. It could get thrown in there at the last second because it doesn't have a material impact. And if it doesn't happen here, keep an eye out. Remember, we've got Secure Act 2.0 that still is going to move through Congress at some point in the future, right? It had unanimous bipartisan support getting out of the House Ways and Means Committee. It's going to be taken up. It's just a matter of when. Will it be later this year? Will it be next year? If you don't see some of the retirement provisions that were bandied about earlier included in this bill, you could very well see them included in a Secure Act 2.0.
Jeff, how
How
you
does
doing?
it?
It's 11 o'clock, Jeff,
Oh
Central Time.
man, time flies, Roger.
I oh, and there's 36 open questions.
All
Um,
right.
I'm I'm just running some numbers in my head. I don't have the software in front of me, but that's a long close of this meeting. One thought I had, I mentioned at the top of the call, we do a weekly sit down on video, and sometimes even I show up on the video, unlike this one. How about we take a look at the remaining questions and we come back and make a promise to try to hit them? Because clearly there's a lot of additional, what about this case? Can you speculate about this? We'll never get to them all, but maybe we can try to come back to those next week and maybe kind of clarify that net investment income tax thing we talked about, try to visualize that. Is that
Yeah, I'm looking at most of these questions, Roger, and it looks like they're all like we've touched on nearly all of these already. The
I saw
one
some
that I see
repeats.
here,
Yes.
yeah, the one that I see here that perhaps we still have a one to look at, or just the bank transactions. And just as a note for all those on the call still, it appears that that is out as well. That was something that they were originally talking about increasing the limit, to make it a higher threshold to report deposits and withdrawals from bank accounts. That appears to be gone also. So almost everything that we were worried about from an advisory standpoint that was in the initial bill is gone, save for the net investment surtax on S corporation profits, the higher surtaxes for our ultra high income individuals. Now, slight change in how it would be applied, but the surtax is there. The qualified small business stock, and then the last one here that we didn't mention, but just business losses, excess business losses, would the prohibition on using them to offset other income would be made permanent. It's not particularly huge news here because it was already the rule for this year and the foreseeable future. It just would be made permanent now. So yeah, lots of stuff that we don't have to worry about going forward, which, hey, it's been a hectic couple of years, Roger. We'll take a little bit of a little weight off the shoulders, a little bit of a break, and let us catch our breath for once.
I'm ready for a break. Yeah. But yeah, like I said, let's plan to return to this subject next week a little bit to try to tie up any loose ends that come out through the week. And who knows, maybe we'll have a whole new proposal. I don't think so. I think we're probably close to the end, but maybe
Bite
that
your
salt thing will
tongue,
come.
Roger.
Maybe the
Bite your
salt,
tongue.
maybe the salt thing, like you said.
Ah.
But yeah, like we said at one point in the call, we've coded this stuff into Halista Plan. So if you want to show some side by side numbers to your client, current law versus future law, that is all in there. It may even allow you to kind of clarify in your own mind how some of these things are working that we talked about with S corps and with potentially some of the phased outs of some of the child tax credits or even the dependent care credit for this year. That is in there. There is a free 7-day trial on Halista Plan. Just go to halistaplan.com. We will put this video up on YouTube. So if you check out our YouTube channel, we got stuff like this. We put our new features on there. And yeah, and whatever we come up with next week will be on there too. Jeff, I appreciate you holding down the fort while my video was off.
Yeah, man.
I mean,
Sure.
you took care of business. I wasn't really able to jump in much, but I think you're the main event people were here to see. Unfortunately, I did want to show some things on screen. We could have actually showed the net investment income tax thing that you were talking about while you were talking about it, but just couldn't get my screen going. So I think we're going to call it there. Like I said, if you had questions that were still out there that weren't answered, we're going to do our best to get to them either separately, individually, or we'll try to dump them into a separate presentation. But thank you everyone for joining us. Thank you for being with us as we were watching the new tax proposals unveil themselves, unwind themselves. And stay tuned because we're going to make sure that we have everything in the system as soon as possible, because with 2 months left to go at the end of the year, we recognize that running real numbers for clients and acting on real planning ideas, some of these things have to happen by December 31st. And so the software needs to be there for you. You need to be prepared to be able to have those conversations with people. So again, thank you, Jeff, and thank you for everyone for joining us.